All right. Hello, everybody. Happy Friday to you. My name is Andrei Knight. I'm with fxnight.com, and I want to welcome you to this webinar today that's being put on with collaboration with fxstreet.com. We're going to take a look at indicators today. Now, I know it's Fibonacci Friday, but we're going to do something a little bit different. Whenever we look at fibs together, you always hear me say that I don't recommend using fibs just by themselves. Okay? I always say that you want to confirm it with some other indicators. And that's what today is going to be all about, what some of those other indicators are that we can use for confirmation. You know, confirm do we have a trend or not, confirm are we in a range, and then, of course, confirm the direction for it. Is this thing just getting started, or does it look like it's about to end? Okay? Those are the kind of things we need confirmation on. And that's what we're going to focus on today. First thing you need to know about indicators, probably nobody's told you this before. What I see a lot of people doing is they'll just take a bunch of indicators, crowd their screen with them, and then they wonder why they can never move. We call this analysis paralysis, okay? You have so many things on your screen. Some things are telling you to go up. Some things are telling you to go down. Some things are telling you to go. Some things are saying no go. Of course you get confused, okay? So probably what nobody's told you about indicators is that there's actually two different groups that most indicators fall into, okay? Not all indicators are the same. Some are similar, and they look at similar things perhaps in a different way, but there's two distinct groups of indicators. The first group are called the trend followers. All indicators are lagging, Ed. They're all based on price, so therefore your computer has to read the price first, do some calculations, and then spit them up on your chart in some other color or shape. But they're all going to be lagging. The idea is to use them in combinations and in certain ways to make up for their lagging effect. But they're all going to be lagging. Volume's about the only one I know of that's not. That's the only indicator that's different. But all the other ones are going to be lagging to some degree. So, the trend followers. Trend followers include indicators such as the MACD. You guys are probably familiar with that one. What you see up on my chart right now, this is called the OSMA. Okay, it's very, very similar to a MACD, except it tends to show reversals a little bit sooner. It responds a little bit faster than the MACD, even with the same settings. And I like the color changes, so I don't have to squint to see if a bar is taller or shorter. I can see it with the color change. But if you don't have OSMA, use the MACD. They tell you almost the same thing, specifically the histogram portion of the MACD. Stands for Oscillator of Moving Averages. Very similar to MACD. MACD stands for Moving Average Convergence Divergence. They use a slightly different formula to measure essentially the same thing. Other trend following indicators. The momentum indicator, if you've ever seen that one. They all kind of fall into the same group. Their job is to measure the strength of the trend and then to warn you when the trend starts losing its strength. Okay, that's why they're called trend followers, as the name implies. There's another group of indicators called the oscillators. Okay, and an oscillator's job is to oscillate back and forth, usually between a set of values. You see one on my charts called the stochastics. All right, very common one, standard, comes with MetaTrader. Other common ones include RSI, also does some oscillations. The difference is stochastics oscillates between 20 and 80. RSI oscillates between 30 and 70. There's another one called CCI, the Commodity Channel Index, and this one's a little different. It has 0 in the middle, and it oscillates between positive 300, negative 300. But they all do more or less the same thing. You can experiment and find the one that fits your mindset, your visual preference, your way of working, your trading system better. But the important thing is to have at least one indicator from the trend following group and one indicator from the oscillating group. Okay? And equally as important as is knowing when to use which one. Because here's the part that nobody told you. Not only do indicators fall into two separate groups, okay, and I don't care which you pick, RSI or stochastics, they're going to fulfill the same function in your trading system. Okay, you still have a trading system, whatever you use up above on your chart. And I do want to stress, what I'm presenting today is not meant to be a complete trading system. It's part of a trading system, the confirmation part, but there's still a trading system up on your chart. I've done prior webinars here where I describe some of my favorite tools for that. And you can visit that link and watch some of those webinars that the folks at FX Street have been kind enough to record for us. But those will discuss some of those other indicators. The part that nobody told you is that when one of your indicators is working, the other one more than likely will be failing you or giving false signals or tricking you into getting whipsaw position. When the other one is working, sometimes the first one might be failing you. So you're not supposed to use all indicators in all situations. Okay? Use a trend following indicator when you have a strong trend. Use an oscillating indicator when you're oscillating in a range to help you find the tops and the bottoms of the range. Okay? An oscillator might braid for a while when you're in a strong trend. A braiding, by the way, we refer to like this, for example, when it's not oscillating. Here it's oscillating more or less smoothly, up and down. Here it's kind of, getting a little spasmodic here too. That's what we refer to as braiding, when the two lines just twist around each other and it doesn't really give you meaningful signals. So there's times when stochastics won't give you a clear signal, or worse, give you a misleading one. And there's times when the OSMA might give you a misleading signal. So the trick to indicators is using the right indicator group in the right situation and knowing when the situation's changed so you can change indicators. Okay? Don't try to use the same indicator all the time in all market conditions. It'll work well some of the time and fail you the other part of the time. So some of you guys that maybe have been having inconsistent results, this could be part of the reason why. You're trying to apply the same strategy to a completely different situation. So part of an indicator's job is to warn you when situations or circumstances are changing. And I'll show you how to do that. The alligator, Ed, is also considered an oscillating indicator. A lot of people might not realize that because it goes up on your chart as opposed to underneath your chart, but it essentially performs the same thing. The alligator's jaws are always they're oscillating between opening wider or oscillating between closing shut, but it's still an oscillating indicator and can perform the same function. And I encourage you guys to experiment around. Find the indicator that fits you psychologically and fits your trading style. But make sure you have one from the trend following group, one from the oscillating group. Next thing we need is a way to tell when to use which one. Okay? And for that, I use the ADX. That's this blue indicator in the middle. That's my tiebreaker. Okay? And I use a value of 30. I just plotted a horizontal line at the value of 30 here. And all I care about, I'm not using the positive DI or the negative DI like most people who use ADX. In fact, I've darkened them out so they don't distract me. I just go for the average line. I made that nice and bright and bold. And all I look is to see if that's above 30. And if so, it tells me that we're in a trend. Or if it's below 30, then I know I'm in a range. So very simple. When it's above the line, it's aiming up, telling me to use the indicator above, or in other words, the trend follower. When it's below, it's like it's aiming down, reminding me that I need to put more emphasis on what the stochastics are doing, or in other words, the oscillating indicator. Yeah, the average is 14 period. That's correct, Kanana. I use standard settings for my trend follower, 12, 26, 9. I use standard settings for the ADX, 14, except I just changed the colors around a little bit. And then stochastics, I use a slightly faster setting. I use 533 for that. Now, technically speaking, ADX falls into the trend following group. Okay? If you don't have OSMA, or for whatever reason you don't want to use momentum or MACD technically, at its heart, ADX is itself a trend following indicator. And let me just color the lines back into their normal colors, and I'll show you how you could use it as a trend following indicator. When the positive DI is above the negative DI, that would be the same as on your trend following histogram posting bright green bars. Okay? When the red comes out on top, or in other words, the negative DI, that means you're posting red bars. Okay? And when the two lines are getting further apart, that's the same as posting bright bars. When they're getting closer together, that's the same as forming darker bars or smaller bars. Okay? So you could technically use the ADX as a trend following indicator. Maybe you wanted to save screen space, for example. I just really like this one personally, because if I've got several charts open at the same time and I'm looking at it from across the room, I can instantly see the reversals. But if you wanted to, the ADX is a very, very precise trend following indicator. As you can actually see, if you look at this curve and then compare it with the ups and downs here, it's actually a more precise trend following indicator than the OSMA. No, the indicator settings won't change, Ricardo. Great question. Because you're measuring the past several periods. So if you go from an hourly chart, I'm measuring the last 14 hours. But if you go to a daily chart, you'd be measuring the last 14 days. So these indicators, and that's one of the things I like about them, is they will scale from time frame to time frame. As a matter of fact, what I really encourage you guys to do is do multiple time frame analysis. Use 2 time frames and try for a factor of 5 apart, or as close as you can to it. So from an hourly chart, you might want to look up to a 4-hour chart to get a sense for direction. But from a 5-minute chart, you wouldn't want to look up to a 15-minute chart. Go instead to the 30-minute chart. And from the 15-minute chart, don't look at the 30-minute. It's too close together to give you a different perspective and might actually confuse you. Go instead to the hourly chart. So try to get a sense of direction from the upper time frame, and then fine-tune your trade and find your entry on your lower time frame. Okay? And what you really want to catch especially are these reversals, the reversal points. If you see it happening on both time frames at the same time, then you know you've got a very significant reversal coming up, and it might be a great time to, for example, take a counter trend trade if your system supports it. All right, let me return the ADX back to its dark dim colors. Get those out of the way. Let me show you a couple things about this chart. Okay, the first part of the chart, ADX was below 30. Okay, ADX being below 30 tells us again what? Ranging. Excellent, Major Hunter. That's correct. Boyke, which part is dark blue? Not quite sure what you meant. The bright blue is the average line. The dark blue are both the positive DI and negative DI. I've got them colored the same color because I don't really use them as much. Yeah, that was the positive DI and the negative DI that I was just talking about. I don't use them in my system. I just use it to be a tiebreaker. But if you wanted to, you could color the DI positive green and the DI minus red, and then you can use it as a trend follower. This is the average of the two. This is the average line, or some call it the ADX main line. Okay, so ADX below 30. 14, correct, Ed. Standard setting. Doesn't have to be fancy to be effective, guys. I tried a few different settings, and I always come back to the standards. There's a reason they've become defaults after 60 to 80 years of use. Okay, not the ADX, but I mean standards for other indicators. Wilder's not quite that old. So back here, we're in a range. Okay, as ADX tells us, being below 30. Look up at your chart. What do you see? Price seems to be ranging, does it not? Okay. Meanwhile, look at your OSMA. very, very small little hills. You know, I wouldn't really call it useful. And look at here, every other candle is a different color. You know, not really useful. This is what the Ozma looks like when it's braiding. And by the way, you'll notice I have two dotted lines here. This is 0.0003 and negative 0.003. The reading has to be above that to be meaningful. That's kind of like my noise filter. If it's inside of that, I don't really take it to be a meaningful reading. So to be meaningful, it's got to make it out at least outside of that. Stochastics, we trade between two lines. Ozma, we trade outside of two lines. So not really meaningful signals here. When ADX is below 30, look at these beautiful oscillations. Okay? And then look over here. Then we had a trend, had a trending move up. Then we had a big drop down. This whole time, ADX is above 30. Okay? When we get the strong moves, ADX is above 30. It measures the strength of the trend. Okay? And when we're above 30, look at how perfectly the oscillations of the Ozma nailed the top of this peak. You know, we're coming up. Uh-oh, we're decelerating. It's starting to curve. You don't have to wait for the dark green candles. You can see it's starting to curve. You might want to bring your stop up to protect your profit, okay? Or you might want to close half of your position. However you do it. You might want to see if there's enough momentum remaining to hit your target, or if you want to move your target to the next lowest resistance level, okay? But you want to be on alert when you notice this decelerating. Now you get two flat bars. Okay, that's giving you a hint. And if you didn't take it, when this starts getting dark and dim, this starts dropping as well. Sometimes this would get bright again and come back up. Then you know you're going to have a second chance. But if it gets dim and keeps dropping, don't hang on to this position hoping it'll come back and give up all your profit. Take what you can get and get out. Maybe you didn't nail the absolute top. If you caught the early warning signs, maybe you did. But be happy with what you got and get out. It's not going to come back. That's what this is telling you. Okay? And then down here, this sharp stab down, really sharp, and really sudden reversal back up. Okay? Once again, this starts retracing. You wonder if maybe this is breathing before it goes on to make a lower low. Your trend following indicator says, no, it won't. And ADX at that moment, notice, dropped back below 30. It's telling you the trend's over. Okay? Take the hints when the market gives them, guys. Don't push your luck. And then ADX drops back below 30. Guess what? We drop right back into a range. We're not looking for breakout moves now. Now we're back to trading a range. And how do you trade a range, by the way? Very, very easy, guys. Take a look at this for a moment. If I draw a vertical line right from the point where the stochastics crossed, okay, take a look at what this looks like. Okay? Top of the range. If I draw a straight line from the time they crossed again, okay, look at that. Correctly identified the bottom of the range. Check, check. Can you guys hear me? Okay. Just wanted to make sure. Thanks. I got a firewall error and wanted to make sure I didn't get logged out. So you can see it identifies the top and the bottom of the range. Let me show you how most people trade ranges. Okay? They'll mark the top, they'll mark the bottom, and they trade horizontal lines when they trade a range. Okay? Here's my problem with that. We identified the bottom of the range, we identified the top of the range. Great. This turn didn't make it to the bottom of the range. It turned early on us. Oops. If you would have put your target here and left the room, you would have seen all your profit evaporate into a loss. Okay, we turned ahead of reaching the bottom of the range. Take a look at this wick. We overshot the top of the range. So the horizontal method is okay, but it's not optimal in my opinion. When I go to trade ranges, I much prefer to trade them with vertical lines instead of horizontal ones. We caught the top of the range here. We caught the bottom of the range here, even though it turned ahead of this prior low. Okay? And let me put a horizontal line where these guys cross. Okay? Stochastics crossed right here. So you would have gotten out here, not the absolute top, but pretty close. You're never going to catch the whole top and bottom. Or what you could do is go, okay, my stochastics just oscillated. I'll stay in this trade with my manual order window open as long as we're going down, and first downturn, I close it because I don't want to push my luck. Stochastics already crossed. If you're a little more aggressive that way and are skilled at manual trading, maybe you could have squeezed out the last little bit. But if you're not and if you're playing it safe, you still caught the majority of that move, just from this oscillation to this oscillation. Okay? I've got a guy in my room who pulls in 500 to 1,000 pips a day in my pro room, and all he does is he sits there on the 30-minute chart and watches the oscillations of the stochastics. Okay? Very, very powerful, especially when ADX is below 30. Okay? Keep in mind this is a range trading technique. So make sure that you're in a range, and the way you can see it, of course, but it's nice to be able to quantify it numerically. Okay? When ADX is under 30, you're in a range. When ADX is over 30, you're in a trend. Let me clear this off real quick, and then I'll show you some particulars of how to use the trend following indicator. Okay? There's several things you can look for in the trend following indicator. First of all, obviously, is the trend getting stronger or is it getting weaker? Okay? And by the way, the bearish move doesn't start with the red. The bearish move starts as soon as you start failing to post higher bars. So it doesn't have to start at 0. This is the whole bearish move. Okay, so that part's pretty easy. You can look a little closer. Is the move accelerating? Are the bars getting wider apart? Or is the slope starting to turn? And you can do the same thing in MACD. Okay, is it starting to round off? Are we showing signs of losing momentum here? Here's a couple other things you can look for in your trend following indicator. This is getting a little fancier now, a little more advanced. This is called a zero line rejection. Okay, we go down towards 0, we reject 0, and then we come back up. Okay? This usually is a continuation pattern. So, for example, if you're sitting here, like let's say you got in long, let's say you went long here. Okay? You saw this beautiful peak here. For whatever reason, you weren't quick enough to get out, which this is an hourly chart. You should have been quick enough to get out. But for whatever reason, maybe your chart looks the same and this is a 5-minute chart, and you just didn't get out in time. Now you're sitting here. You're giving back half your profit. You're wondering if it's going to come back, or if you should get out and at least take the half of profit you have remaining before the winning trade turns into a losing trade. Okay? Boom. You see a zero line rejection. That usually is a continuation pattern, meaning whatever direction the move was going, it's going to keep going. So, and sure enough, we come back up. Okay, let me show you, and that wasn't even a perfect example of a zero line rejection. Here's a nice example of a zero line rejection and why you might want to pay attention to them. Okay, you have this little move up, then Osma comes down and you have a zero line rejection. Sure enough, the trend continues. You have this little move up. Then we cool down. We have another zero line rejection. And guess what? You have this move. And that move is much bigger than these prior two moves. Okay? So part of the reason the other one wasn't such a good example is because ADX was below 30. When you got this zero line rejection and it cleared these prior tops, at the same time you crossed above 30. So now you know the trend following indicator is in control. Okay? And yes, you can use trend lines just like you use them on your price chart. You know, for example here, draw a trend line, look for a break. Okay? Same technique you can use down here. We made several prior tops, draw a trend line, look for a break. Oh, guess what? That break happened the same time ADX crossed above 30. Something's going on. Okay? So you can absolutely draw trend lines and things like that also on your indicators. In fact, one really useful thing you can do with trend lines on an indicator is spotting the end of move. Okay? Let's take a look at this one. Price is moving down. had a slight retracement to the upside, and then comes back down, makes a lower low than before. That's usually a promising sign, right? Lower lows means we're going to have the downtrend continue. Suddenly we reversed up and never quite came down there again, okay? Remember, if I scroll this chart back, that was right before that explosive big move up. It took a while to shake the bears out of the market, but eventually the bulls had their way and this thing exploded up. Well, was there any way to predict that? Okay? Let's connect the bottoms. Price made a lower low. But take a look at our indicator here. Our indicator failed to follow through and didn't make a lower low as well. This is what's known as a divergence. There's a divergence between this line and this line. They're not going in the same direction. Normally, when price makes a lower low, your indicator should also make a lower low. When it fails to do that, that's a divergence. And if you're short, that's your clue to get out. It doesn't necessarily mean there's going to be a long that's going to erupt out of this. It did this time. It could also stall in range. That's part of what makes counter-trend trades riskier than with the trend trades. Because counter-trend, you don't know if it's going to explode. It might just range a while. Okay? But it does certainly let you know that whatever move you were in is over. Done. Finito. Okay? Don't push your luck. If you see a divergence, it's time to get out. If you're a counter-trend trader who likes taking the end of trends and going in the opposite direction, then look for divergences. That's your cue to start doing an analysis and maybe looking for opportunities. The thing with divergences is they'll happen on all time frames, but the higher the time frame, the more significant the move. If you see a divergence on a 5-minute chart, the counter move can last 5, 15, maybe 20 minutes. Okay? If you see a divergence on a weekly chart, watch out. A major market shift is about to happen. We saw one on gold as it was dropping before it made the low at 730. We saw one on oil at 147 when it made that top. The euro made a divergence at 160 before it started its move down. You will always see divergences before the end of a big move. Okay? People were excited by this move. They try to make a bigger move, but they couldn't get as much from their side as enthusiastic supporters. Far less sellers, far less selling momentum on the second try than on the first try. Despite making a lower low, you'd think people would be excited. If a move happens and breaks a prior record and nobody gets excited, put your ears up. Something's wrong. That's part of the reason I like having volume on my chart. Now, people say there's no volume in Forex. There absolutely is volume in Forex. The problem is you get volume from your broker only. There's no central exchange. It's what we refer to as tick data. Okay? But you remember I mentioned sometimes it can be a leading indicator. So considering it's the only indicator different from all your other indicators, I'd rather have data from my broker only rather than no data at all. It's sort of like sampling during election time or polling. You interview a few people as they come outside, and you assume those few to represent what the majority did as well. Okay? So it's not perfect, but it's better than nothing. It's a useful tool. If you do want to know how to get volume from as close as you can get to the entire interbank Forex market, we have a really powerful proprietary charting package that we use with our own pro traders. We worked out a deal with some brokers for you guys to be able to get for free. And that'll give you volume information from 140 different banks and liquidity providers. So it's the closest thing you can get as a retail trader to seeing what the banks see when they make their decisions. Let me find an example of a bearish divergence. You just saw a bullish divergence to the upside. Let me see if I can find a bearish one for you guys. Pound's been falling a lot lately, so it's kind of hard to start the beginning of the move, but I'll see if I can find an example for you guys. And then I'll take your questions. Don't worry, I'm not ignoring your questions. I'll leave time at the end. Here's one. Take a look at this, guys. Price made a higher high, right? If I connect these peaks, take a look at the indicator if I connect the same peaks on the indicator. That doesn't look good, right? Bulls managed to make a higher high. They didn't gain any enthusiasm from the crowd while they were doing it. And take a look at what happened. Boom. Crash down. Okay? So that's a bearish divergence. Okay? Incidentally, volume too. Something very interesting. The way that I use volume. You have this big drop, and as we drop more, people get more and more excited. Volume picks up. Okay? Only natural. As more and more, as this move gets longer, more people see it. They want to profit too. They jump on board. If you suddenly have an extension on the move and volume drops off sharply, the smart money's leaving the party, guys. They're taking their chips off the table and going home. And you know what? Maybe you should too. That's why sometimes volume can be a leading indicator. Okay? Because you see the change in volume, sometimes a bar or two. Here's another example. Look at this down move here. Look at what volume started doing back here. Okay? A full candle ahead of the end of the move. Okay? That's why I say it can sometimes be a leading indicator. It'll warn you when interest is dropping off in a move that you might be tracking. Okay, so there's lots of innovative and creative ways to use indicators. You could connect two peaks on an indicator and look for a break of that trend line. That would have gotten you into this trade right down here. Okay, so there's lots of creative ways, and FX Street is recording this webinar, by the way. It'll be up on my author page with them. Probably, I would guess, in a week or two. So I don't expect you to memorize this all at once, but draw a trend line just like you do on price. If your indicator breaks that trend line, you'll be alerted to a move. So lots of creative ways you can use your indicators and make up for their lagging effect. Okay? Or using them in combinations. Okay? If you see the same thing on both indicators, you know, then they're in agreement. That's wonderful. But if you ever get analysis paralysis and your indicators are giving you two different things, then use ADX as the tiebreaker. Okay? Now let me get some of your questions in the time that we have remaining. Oh, Chow, thank you very, very much. I'm glad our time together is proving useful. I'm in here every Wednesday and Friday. Same time, 1300 GMT. And if you guys ever want to spend more time together, here's information about my pro group. But thank you very much. What happens when the ADX stays at 30? Great question. Either it can mean that my indicators are in agreement, and then I don't need the ADX to be the tiebreaker. Or if one indicator is bullish and one is bearish and ADX is at 30, I'm just going to stand aside. Keep in mind, you always have that third choice. You don't have to trade. And in fact, overtrading is the #1 cause of losses out there. So step back and wait until you're really sure. If something's giving you reason not to be sure, step back. Usually 1 or 2 more candles will help you make up your mind. The ADX does not in itself tell you what direction the trend is in. Okay, it's direction neutral. It just tells you whether that trend is getting stronger or weaker. Your trend following indicator will tell you which direction the trend is in. Or if you color the positive DI green and the negative DI red, then when the positive DI is on top of the negative DI, you know the trend is up. When the negative DI is on top of the positive DI, then you know the trend is down. So if you make use of the other 2 lines, then it'll tell you. But the way I use it, it's neutral. It's just telling me the strength and weakness and whether I'm in a trend or a range. I can see by the color what the trend is. Believe me, you use my system long enough, you're going to think it's Christmas all year long. You're going to be dreaming in red and green. Okay? You've been warned, guys. Jeannie, my Ozma is a custom indicator that some of our programmers kind of tweak to our specifications. I know there's lots of different Ozmas out there. I don't know what all of them do offhand. If you visit forexpsd.com, they have a lot of indicators you can download. Look around over there. maybe they'll have a few different osmas you can try. Anybody that's a pro subscriber with our group, or anybody who uses any of our brokers, they're all listed on our website, fxknight.com. You get my charting template for free, which isn't just these indicators. It's everything that I use, all my custom indicators, already set up with templates to pre-configure them ready to go. It's the same charts that I use when I trade my funds. And we give that away free, but only if you use one of our brokers or if you subscribe to our pro training. Reason is, I don't want you guys using a complicated tool without the proper understanding. Okay? If I sell the tool without the training, then people misuse it, they start losing, and word gets around that my tools don't work. And we can't have that, because they most certainly do. K9, it sounds like the issue you're running into may be a psychological one. Okay, maybe using some of these indicators in this combination can help you in reaching your decision, but psychology is certainly a big factor. Sometimes we get the green light and we hesitate before pulling the trigger, and other times we get the red light, but we want to trade so badly we ignore the signal and get in. It's a matter of practice. If you're not doing consistently on demo, don't even try live. But once you get consistent on demo, if you go to live and you notice your consistency suffers, go back to demo. It doesn't have to be a one-way switch. Get your rhythm back on demo, then place a couple trades on live while you're in a winning streak. If you notice your winning streak breaking, go back to demo, get your footing, get your rhythm back. The other thing is use much, much smaller positions on your live account than you do on your demo account, and that'll reduce the psychological stress at first, okay? Get the consistency the same as you had it on your demo account, then gradually increase the position size. But a lot of times what happens is the psychology gets in the way of executing the system properly. I was drawing the line as close as I could to the crosses, Ed. Where you enter depends on where the cross happens. The operating range with stochastics is between 20 and 80, okay? Now, here's the deal. A lot of people, when they teach stochastics on their websites, I believe do it a little bit wrong. They tell you to get out of your longs as soon as it becomes overbought. If you follow that advice, you would be out of this uptrend here, okay? I think the stochastics give you three distinct signals. When they cross above 80 and become overbought, or below 20 and become oversold, when they cross out of bounds, consider that as a warning to think twice before you take a new trade, meaning the train has already left the station, okay? Doesn't mean you can't enter, but think twice and make sure you really want to. Get other confirmation. So this is your warning to think twice before entering new longs. When they cross and the red comes out on top, that's your warning to get out of existing longs. That means the bears are overpowering the bulls. Okay, the cross is the point of overpowering. And then when it falls back below 80, or in other words, comes back into range with the red on top, that's your first short signal. Okay, so three distinct signals, not one. I drew my lines just on the cross for ease of explanation, but to fine-tune, if they cross below 80, your exit is also your entry. If they cross above 80, then that's just your exit, and you wait a little bit longer to take your entry. Okay? And again, these indicators, these are just confirmations. Make your trading decision up here first, and then look to the indicator to help you fine-tune the timing. Don't go, well, Black Knight said to short every time this crosses below 80. No, you got to take a look at what's happening on the chart, you know, and make sure the situation justifies a short. This just helps you fine-tune the timing. But three distinct signals, actually, Ed, to be precise on the stochastics. And then same thing in reverse. This is where you want to think twice about entering any new shorts. This is where you want to close your shorts, but you want to wait till we get back up above 20 to enter new longs. Look at the chart. You didn't miss anything. This was back and forth ranging to upset your stomach. Okay? We didn't really take off till here. So you would have been fine waiting till here, and all you would have missed was a bunch of market noise. FX admin, I realize we're almost out of time. If I may, could I have about 5 more minutes just to answer the last few questions? Please let me know if that's possible. When you see a divergence, Sala, the best place to enter, it depends on what time frame you're looking at. The higher the time frame, the more significant the move will be that the divergence is forecasting, but the longer it may take before that move starts. If you see a divergence on a weekly chart, it could still be 2 to 4 weeks before it begins. So it's more an exit signal if you had been long. To get in short, I would draw a trend line and look when that trend line breaks. That might be a good way to enter in the opposite direction. And Sala, that's correct. It's not so much to find a bullish divergence, you would connect the bottoms. Basically, in an uptrend, you connect the peaks at the top, and in a downtrend, you connect the peaks at the bottom. That's how you look for divergences. It is sort of Fibby Friday, Boyke. What I'm doing is, a lot of times on Fridays, I'll tell you guys, don't use fibs by themselves. Use them in combination with other indicators. So I thought we'd take one Friday out and take a look and see what those other indicators are. And since FX Street is making a recording, in the future when people ask that question, then we'll just point them to the link and they can see what the other indicators are. It's like this webinar, correct? We spend 2 hours together every day. We start the trading session together. We finish the trading session together. I leave you guys alone in between to find your own trades because I don't believe in running a signal service. I don't think people learn anything. I think you learn faster by doing. So I do my best to set you guys up with some trades. Then we go our separate ways and trade. Those that prefer to trade in a group, the room stays open. It's like this room, but users can share charts with each other, okay, and collaborate together. And then at the end of the day, we meet back up and see what worked so well, what didn't work so well. So it's very close to the sort of mentoring you would actually get if you were hired as a junior trader in a bank. You have to add 30 as a custom value, Ed. Right-click on your ADX, go to Properties, and then click on Levels. And then you'll be able to add that custom 30 level. Variable 1, thank you very much for your vote of confidence. All right, guys, I've just gotten a signal that it's time to wrap up. No, I don't use Hotcom. I use software called iVocalize. It's much more interactive, I think. Thank you guys very much for your time and attention today. My thanks to FX Street for recording this and for making this forum possible. And I'm at fxknight.com. Stop by and say hello sometime. All right. Good trading, guys.